Okay, it looks like we have about 231 people here, so let's get started. For those of you who don't know me, my name is David Guzy. I'm the owner of the Guzy Group. We are a firm of real estate underwriters. And in today's video, we are going to learn how to build an investor waterfall in Excel. The specific type of investor waterfall we're building is return of capital and then GP-LP split. Before we start building it, let's make sure we understand what that means, because we got to understand that first. So you see on my screen right now, there's a picture of a house. Let's say you and your friend are buying a house, okay? And you're throwing $100,000 into that house. And you say, okay, we're going to throw in $100,000. And year one, we're going to make $30,000. Year two, we're going to make another $30,000. Same with year three, same with year four. And then year five, we're going to sell the thing and get $150,000. When it's you and your friend and you both are throwing in, 50-50 investment, you're throwing in 50 grand, he's throwing in 50 grand, everything's split, So in this case, you would throw in 50,000, but you would get only half of it. 15,000, 15,000, 15,000, 15,000, 75,000. You're putting in half the equity, you're only getting half of the squeeze. So it's different in commercial real estate. It doesn't work like this. In commercial real estate, what you have is something called a GP. Let me write this down. And an LP. Okay. The GP is the general partner. That's the person that they're not going to be putting in the money. If they do put in money, it's a little bit just to have some skin in the game. But usually, a lot of times, they don't put it in any money. The value they add, though, is they're finding the house. They have to find. They're going to look on the market, find a lot of houses, talk with a lot of sellers. They're going to close on it. They're going to operate it and manage it a lot of times, or at least oversee the operation of it. And then they're going to sell it too. So they're the ones doing the work. The LP, limited partner, they're supplying the money. Okay. So in this type of structure, when you have someone doing the work, and then you also have someone just doing no work and giving the money, how do you do it? It can't be a 50-50 thing. That doesn't really seem fair. That's where these waterfall tiers come in. And there's a lot of different types of tiers out there. Some of them are very, very advanced. The one we're looking at right now, return of capital, GP-LP split, it's basically as simple as they come. If you're going to do this for a private equity firm, do these types of models, you got to learn this one. I mean, this is waterfalls for dummies. So in that case, how would it look here if we were to do this scenario? Well, first, it starts with the project. These are project cash flows. So you buy the asset, in this case, the house, for $100,000. And it's going to produce these returns. And this is what the project returns. Now, how did the GP and the LP get compensated? Though that's where the waterfall comes in. So in this case, let's pretend it's going to be a return of capital. And then it's going to be a GP-LP split. We'll say the GP gets 60%, the LP gets 40%. So in this case, let's do this just to make it a little bit easier. We're going to say LP, return of capital. So the LP invests $100,000. So first, all this cash flow first has to go to pay back the $100,000. So year one, $30,000 all goes to the LP. Year two, $30,000 all goes to the LP, because the LP threw in $100,000, only has been paid back. Let's add this up. $60,000 so far. Year three, all the money goes to the LP, because you add these together, $90,000 has been returned. But remember, they put in $100,000. Year four, here's where the split starts to occur. To return the capital of this $30,000, how does it get distributed? $10,000 first goes towards returning the capital, because look, you add all these together, $100,000. That's what the investment was. All capital has been returned. So 10 of this 30,000, 10 goes to returning the capital. How much is left? Now we have 20,000 left. Now, how's that 20,000 divvied up? Well, in this little example, we said the GP is entitled to 60% of it. The LP is entitled to 40%. So let's do this. We're going to do 20,000 times 0.6 for the GP, and we're going to do 20,000 times 0.4 for the LP. Okay. So now you can see, you add these all together, that 30,000 matches what was right here. Last but not least, you have year five. How does this get split up? If you think about it, return of capital already happened. LP's been paid back. This 150 no longer goes to this tier. It goes straight to the split. And once again, for the 150, it's going to be 0.6 for the GP, and it's going to be 0.4 for the LP. Okay, so now I'm going to take these line items. Let me put them right here, and let me put them in the order we did it. The LP, if you look at their total cash flows, it's going to be this plus, here's the LP line. You bring these together. And then for the GP, it's that. You add these together. If you add everything up, the GP and the LP, all the returns, 170,000, that should equal the exact amount that the project pushed out in cash. Well, minus, let's get rid of the 100,000. The project distributed 270,000, same as the project up here. So we know our math is right. So hopefully, high level, little example, it makes sense now what return of capital and the GP-LP split means. So with that said, let's go into the actual waterfall. So first off, when you build these things, feel free to use my template or hire me if you want. But you want to make these look pretty because these are going to go to investors. And the prettier it is, the easier it is for the investor to understand what's going on with the project, and the more likely they're going to invest with you. So what I like to do is I like to start off at the top. What's the waterfall structure? Tier 1, we're returning the capital. Tier 2, it's going to be an LP-GP split, 60% going to the LP, 40% going to the GP. So definitely do that. Second thing, what we want to do next, project cash flows. So like I did over here, this little example, remember we started with the project. This is even before anything gets split. There's no GP saying, give me my money. There's no LP saying, give me my money. We're just saying, what is the project doing? What are we working with? And that's where this comes in over here. So we break this down into two things. First is equity. This is equity invested into the deal. Now, where is this pulling from, you might ask? You know, I have a financial model. Let me try to move this. I have a financial model over here, and this is a real model, a real deal, and it's basically outputting. At the end of the day, it's saying, here's the equity invested, and here's the distributions from the project. So for your own waterfalls, you're going to have your own templates, your own deals that they're going to shoot out this cash flow. But what's important when you start to divvy up between the GP and the LP is the project cash flow. So you got to get to this point. And I could show you how to do that in another video, but you got to get to this point. So here's the equity. And what this is saying is in October 2024, 1.6 is being invested into the project. And it looks like there's nothing else being invested for the 5 years. Now, in regards to distributions, we have two types of cash flows. You have operations and you have special events. Special events are distributions from refis and exits. Operations are just distributions from operating the facility. You want to break those out. It doesn't matter so much for this specific one, but a lot of waterfalls, they're going to say, hey, operations cash flows are treated different than special events cash flows, and you want to make sure they're separated. So always separate them, even though in this case it doesn't really matter. And in this case, you're going to see operations distributions. They start to kick in March 2027. They grow because we're raising rents. And then we exit with a big exit of 5.8 million. So you pull these in yourself and you want to add these together. You add these together and you want to pull these to the right. There you go. Okay, so let's start with the investor waterfall. So we said the first thing, remember, tier 1, return of capital. We got to return the investor capital. So what you're doing here, you're going to build something that's similar to building, let's say you're building a mortgage calculator where you're just paying down the loan. You know, you're starting with a certain amount, maybe $5 million, and you're just paying it down. You know, the same logic for that applies to this. So basically, start a month. What is the investment owed? Well, when you're starting the project, the very first day before you raise the money, it's zero. There we go. Additional equity owed. Well, that is going to be these equity draws, how much equity is required. So I am going to pull from here. Now, you notice up here it's a negative number. I like dealing with positive numbers. It doesn't matter if you do it negative or positive. It's a choice. I like doing positive. Obviously, if you do negative, you're going to change the equation a little bit. So we have this, and we're going to say, what is the tier 1 payback for the LP? So once again, this is the return of capital payback. Where's the payback coming from? It's coming from these two cash flows, the operations and the special events. Here's the total right here. So we're going to go equals this And at the end of the month, end of October, how much is owed? Well, it's going to be the start of month, which is zero, plus any additional equity that we're going to have to pay back, minus the amount paid back. Okay, let's do that. And now all we're going to do is go here for November. What's the starting balance? Starting balance is the ending of October. What's the additional equity owed? Well, in that case, you just pull it over. In this case, it's zero. But if I were to add, I would do a negative. If I were to add negative $500, you're gonna see it flow through. But we're not doing that. Okay, and what's the LP payback? Right here, zero. And we're gonna drag this over too. And then once again, I'm gonna do it one more time, just row by row, and then I'll just drag it all. December 2024. What's the starting balance? It's gonna be the previous month. Equity owed, nothing new. Here's the payback and the total. So now I'm going to drag it, and you're going to see I'm purposely leaving something out. So I want to see this. I want you to watch me make this error so you don't make it yourself, because I made this error before. Okay, so now what we're looking at is, let's follow this little by little. Start by month, zero owed, additional equity owed, nothing paid back. So we have this on the books. We owe this $1.68 million. And look, there's no cash flow from this asset, so nothing's being paid back. We still owe it. We still owe it. We still owe it. Look, nothing's changed. We still owe it. Now we're starting to pay the thing back. Okay, so you can see, look, here's what we owed. Now here's some payback. Remember, all the money from this project is going to go towards paying this back until it's paid off. So 1.6 million minus a little change, $1,000. We made a little bit of progress. We're going to do the same thing next month. Pay back a little bit more and a little bit more. So we keep going. Like this is dwindling down. We keep paying it off little by little, and then boom, we're going to have this big exit right here, the 5.8, which is going to pay it all back. So we started with 1.1, no more additional equity owed. Now we're going to pay back. But now here's the problem. I purposely made this mistake on purpose. We're paying back 5.9 million. But, in this one tier, you only want to pay back the max of what you owe, and we only owe this 1.1. So you got to put a little bit of a formula in here, and you're going to say, I want to take the minimum of this value or what I owe. Okay, now you can see how this is working. We started September owning $1.1 million. We had this large exit of almost $5.9 million in cash. But in regards to that $5.9 million, only 1.1 is going to be going towards this tier. And that gives us an end of month balance of zero, which is what we're looking for. So let me drag this bad boy all the way back over here. Okay. So now we're good. Now we want to do cash flow for tier 2. So remember, this is tier 1, return of capital. How much money after we completed tier 1 is going to now be going into tier 2? Well, you want to say, here's the amount of money from the project that I have to give. I mean, where's the money coming from? This is the source, the 5.9. And how much did we pay back in this first tier? We paid this back. So this is the amount for tier 2. So let me pull this all the way over. Okay. So now tier 1 is basically complete. And that, once again, that's the return of capital. We built the logic where we had the amount of money we owed, and it dwindles over time, and then we have this big exit event, and our capital balance is all returned. It goes to zero. And how much money do we have left over for the next tier? We have this 4.8 million. So now let's go to the next tier. And like I said, you guys are going to see how easy this is, because this is one of the most simplest waterfalls. But all we're going to do is LP share. We're going to go equals, here's the amount for tier 2 times the LP share. Don't forget your little dollar signs here. And then we're going to do the same for the GP share. And we're going to drag these out. Oops. Let me drag that out. Fat fingered it. Boom. Okay, so let's start from the beginning of time. Cash flow for tier 2. There's nothing. Why is there nothing? If you keep going, there's still nothing, because everything is going towards return of capital. But at the exit, we have this $4.8 million for tier 2. based off of the rules that we said all the way over here at the beginning, 60% of the LP, 40% of the GP. You add these together, 4.8, 4.8. So there you go. And you also want to make this very dynamic, to do 50-50 and see how everything changes. But bottom line, in regards to how the cash flows get set up, you're done. The hard work, quote unquote hard work for this example, it's all done. Pretty simple, right? Now, let's figure out what the actual investment returns are. So let's start here. We're going to start on the project level. Once again, this has nothing to do with the GP, the LP, just on the project. What did this thing make? So let's look at the distributions first. Gonna put these in over here. So that flows. Let's look at the equity draws. And equity, if distributions are positive, equity has to be negative. Okay, so distributions. Let's sum that up. Equity invested. Let's sum that up. And then we're going to say the equity multiple. Let's do that one first. It's going to be distributions divided by equity investment, but let's make it, actually, let me make equity invested. Let me make it positive here. Okay, and then project IRR. Definitely use the XIR. Don't use IRR, guys. Use XIRR. XIRR incorporates the dates. It looks at this October, November, December. That's very important, okay? Because I've seen models do an IRR, and then I ran it XIRR. It was wildly different, enough to make or break investing in a deal, So XIRR is definitely the way to go. So always do that. So with that said, cash flow amounts. Let me sum this up. Got the total. So let's do this. XIRR. Cash flow amounts. We got this. Cash flow dates, the most important thing. And then it says guess. I don't know why it says guess. You can plug in any random number. I'll plug in 5%. Okay. So what this is telling us, this is project level. Okay. So this is just looking at these cash flows on the project and saying this project is a 32% IRR and a 3.86% equity multiple. I throw my money into this personally, especially when the stock market is only giving 9.5% on average. But I digress. So let's go to the LP returns. Now for LP, remember this was project that we did. Now we're going to say, what does the LP get? Remember, the LP gave the money. They don't do the work, but they gave the money, so they get some returns. So what I did, you probably didn't notice this, but anything in green is where the LP gets paid back. It's in green. So you can see tier 1, it's in green. Tier 2, it's in green, and the GP's in blue. So let's go over here. The distributions to the LP. The LP is going to get their capital returned, which is this line right here. And they're going to get some GP LP split. So that's right here. So that's the first thing. And then let's look at the equity draws. In this case, all of the equity is from the LP. The GP is not giving anything. So we're going to just pull from here. And last but not least, let's pull this total. I'm just going to copy paste from above. Boom, there we go. Okay, so total LP. Now I'm gonna just copy paste this and see if this works. Okay, this is pulling the correct LP distributions. This is pulling the exact cash flow. This is pulling correctly, perfect, and this is pulling. All I did, guys, was copy and paste. Since it's in the same format, it worked. So what this is saying is that, once again, the project, let's start at the project gives us a 32% IRR. But remember, the project cash flows, some are going to LPs, some are going to GPs. I know I'm repeating myself with this, but I know some of you are new, so you got to get that. So this is the project. And then you say, okay, what's the LP getting? The LP is getting 23% IRR and 2.72% equity multiple. Not bad for just giving money and not doing any work. That's pretty good. So now you're going to say, what's the GP getting? So once again, we got to look at the GP cash flows. So the GP didn't give any equity, so they only get cash flows. So let's go over here and do GP. And remember, GP, they only get paid in tier 2. They don't get paid for return of capital because there's no capital to give. So GP cash flows, there you go. Now here's the thing with the GP. Let's add up these cash flows. Here's how much money the GP gets. Equity invested, 0. IRR, it's not applicable because they didn't give any. They gave 0. So there's no IRR and there's no equity multiple because once again, they get 0. So what this is saying is that this project is going to give $6.4 million in cash flow. And of that 6.4, the LP is going to get 4.5 of it. The GP is going to get 1.9 of it. So we're going to do equals this plus that. It needs to equal the project. I don't know why it's in percentage, but let's double check. This should equal this. And it does. And then, yep, that matches. So that should be good. So now, what we just went over, once again, we looked at the project cash flows, and there was a rule set. It said, hey, for this waterfall, you got to return the capital, and then you got to split it from a GP and LP. And that's exactly what we did. So now we can go to investors and say, hey, guys, here's the project level returns. And if you invest with us, you do none of the work. You just give us your money, and here's your returns as well. There's many other things you could do in regards to investor returns from this. You could do some cash on cash equations to show exactly year by year cash on cash return. I have another video on that, and I'll be giving another presentation on that. But if this makes sense, hopefully this makes sense in regards to the simplest waterfall, and everything we review moving forward is going to be based off of this concepts. So thank you, everyone, and we will meet again in about 20 minutes.